Hi, Leonor here. I'm back with another problem. 5-20 in your textbook on page 232. This is the cost volume profit applications, or CVP, one of my favorite chapters. It's all about relationships. We're being asked to do a couple of things. Compute the contribution margin ratio. That's what the CM stands for. The break-even point in the number of balls. So number of balls sold in order to have a net operating income that will be 0. And then the degree of operating leverage at last year's sales. So I retyped the problem information and I highlighted in purple the items that are very important. The company has a ball that sells for $25. This is important because this is the per unit cost. Variable expenses, $15 per ball. So let's just put that in, $15. Now this 60%, that's going to come in, that's important, but for a later point in time. So if $25 is the selling cost per unit and $15 is the variable cost per unit, it stands to reason that the contribution margin will be $10 per unit. That's important because it's based on the information given. So at the per unit cost, we want the percentage. Let me put that in here, percentage. We need to determine what is the ratio or the percentage of the contribution margin. You can do it using total sales, total dollars, or we can do it on a per unit basis. Let's do it on per unit. So if we look, $10 and $15 equal $25. So what we're going to do here, and I do it a little bit different than the book, we're going to set up total sales as the 100% sales. So sales are 100% per ball. And to calculate the contribution margin, we would take the $10 per unit and divide it by $25, which is the selling price. So the answer to the second question, or the first question actually, is, I'm trying to highlight this for you, 40%. So what does that mean? Well, 40% of every sale is going to cover fixed expenses. So that's it. That's the contribution margin ratio. And by the way, you could calculate what the variable expenses were, 100% less 40%, or the percentage if you want to be really slick. Take your $15 and divide it by $25. There you go. Now let's calculate the break-even point in the number of balls. So for this company, Northwood, to come to a break-even point, which means that net operating income is 0, or Z, I like to start from the bottom up, or reverse engineering. So we know net operating income must be 0. We also know that unless we're told otherwise, fixed expenses will not change. Okay, so the contribution margin must be the same as fixed expenses in order to come up with a net operating income of 0. That's a little bit of just plain old logic there. Okay, so we're looking at contribution margin of 210, fixed expenses of 210. You might be thinking, Lenore, this doesn't answer the question at all. Just a little math is necessary. So if contribution margin is 40% of sales, we could take the contribution margin in dollars and divide it by the ratio. And this will give us the total sales at break even, total sales dollars. So now you're thinking, okay, Lenore, that makes sense, but that doesn't give me the break even point in balls. And you're right. One more step, we could actually take the total sales, divide that by $25 per unit, and the solution would be at break even, the company would sell 21,000 basketballs. Now, some of you are really good at math, and you've realized there's another relationship and a shortcut. So you're thinking, well, Lenore, if the contribution margin is $210,000 and I divide it by the per unit cost for the contribution margin, I will get 21,000 balls as well. And you're right, there's two ways to approach this problem. Actually, there's more ways. You can memorize the formulas. I'm not a formula person. I have trouble remembering them, so an accountant at heart, I prefer to look at the contribution margin income statement, determine the relationship by per units and a per unit cost, and a relationship with percentages or the ratios. And when it comes to break even, let's reverse engineering, because we know at break even, net operating income is 0 or Z. So with that said, I'm going to shut down and then answer part B in a later podcast.